thank you very much for taking the time to join us and not watching Wimbledon. I'm sure there's very exciting games currently going on, but hopefully Emma will prevail. But here we go. Let's run through Bankers Investment Trust. So for those that know us well, forgive me for a few minutes now. I'm just going to introduce the trust and explain what we do and how we do things, and then we'll really move on to positioning and outlook and some of our key investment themes. So if we jump on a slide, my trusty helper, thank you very much, Roland. So as this name says, we're investment trusts, so we're listed in London. We're global, we're equities, and we're growth and income. So believing in growing capital and income. We're not a financials sector investment trust, despite the name sounding like we own nothing but banks. Interesting history. We launched a long time ago now, 1888. But really for small clients of a bank in those days, Glyn and Mills ended up in NatWest. But really to allow us to democratize investment for their small investors. And we're still living that aim really. For just over £1 a share, our investors can get access to the best companies around the world. So very much the objective, growing capital against the benchmark there, the FTSE World, and importantly, growing income above inflation. So that's real growth of inflation. We're £1.5 billion of assets, so big old trust. That gives us enough scale to go anywhere and to do it efficiently as well. We just opened a new trading license in Vietnam, for instance. So really, size matters, I think, in that sense. Ticker of BNKR. I'm the lead manager since about 2003, when I took over from Michael Moore, who was the previous manager, who did 25 years of managing this trust. So really, again, continuity of two managers now over nearly 50 years. And then finally, the discount really quite wide at the moment, in our opinion. That's why we're buying shares back. But the 10-year average just under 4%, and we've been on a premium in the last few years as well. So, I think it's unusual to be out this wide, and hopefully we can, through the share buyback, get that coming in. Core principles on the next page. Really sort of twin objectives I've mentioned. Most trusts don't, they just have a sort of total return. I'm a long-term believer that income matters, and investing in good growing dividends over the long term does matter. Again, it's been more of a struggle the last few years as growth has been so preeminent. But consistency of style and consistency in terms of what we're trying to invest in, that's very important to us. I mentioned that earlier as well. And then equally for us, I think there's some balance. So being able to shift a little bit between value and growth investment styles, I think also matters. And you see that in the way we've been behaving. We'll talk about our outlook in a minute. But we've moved a little bit more sort of middle of the road than we were pretty much all out growth 2 or 3 years ago. And I think with interest rates rising, it's right to have a little bit more value within the mix of the trust. We're global specialists, managing regionally, and you'll see the team in a minute. And they're all sitting within their regions, which I think is important as well. Growing dividends, we're right behind City of London, many of you may be aware of, which has a 57-year growth record. We are too. We're just 3 months after that in terms of dividend rises. So every year since 1966, we held the dividend in 1966. The record goes back pre-war, before I can't actually find a dividend cut. So a great long-term record. And then finally, low charges. The ongoing charge, so that's more management charge and admin fees, is just about 0.5%, and low cost of debt. So let's just jump on one more. I'm employed by Janice Henderson. They're the managers of the trust. The board appoint us to manage the assets, but we're a big firm, manage 11 trusts. I said City of London is in the stable, Henderson smaller companies you may have heard of. So, a really long-term core. I've been managing investment trusts right from the beginning of my career in the early 90s. So again, we've all very experienced investment trust managers, and there's a big firm behind us, 159 investment professionals. Just in the US market alone, we have 40 analysts covering US stocks and the US market. So again, that depth, I think, really comes to play in the trust. The team itself on the next page, the bankers, we run, basically, we're regional. We run sort of 4 sleeves, I suppose, 4 portfolios of regional Pan-America, as it were. North America is predominant amount of that, Pan-European, Japan, and then sort of Pan-Asia sleeve. We're really trying to find 25 to 30 holdings in each area. So reasonable concentration, therefore, good tracking error. It gives us about 100 holdings. And as I said, it's a focus. I think what unifies us all is a focus on trying to find companies that generate free cash flow. So cash over and above what is required to manage the business. And that generation of free cash allows the business to deleverage, to pay off debt, maybe for acquisitions, maybe for growing CapEx, but also importantly for me, I think, is growing dividends that we get back from our holdings. Not everything pays a dividend. There's some great stocks that we own, particularly in North America, that don't pay dividends, but down the road we do hope they turn up with dividends in the future. And we've in the last few months obviously seen Meta, announce a dividend. So hopefully some of our core holdings that don't pay dividends will continue to. But I think that focus on free cash flow is really what unifies us all. And we're all specialists. Each of these managers, Jeremiah sits in Denver in the US, Jamie's here in London, Junichi in Tokyo, and Sat in Singapore. So they're all within their region, really focusing on their key stocks. What that generates in terms of income and growth, the next page, Roland, gives us our income. The green line here is bankers' dividend growth. So back when I started, sort of early 90s, £100 worth of dividend is now being generated, £1,200, or sorry, £1,500 of dividend. So huge growth by investing in good quality companies that grow their dividend quicker than the market, far outstripping inflation. CPI there sort of, barely at 200, barely doubled. So, what we've done over the last few years on the right-hand slide there is the 10-year rolling sort of inflation, 2 times inflation in red and 3 times inflation in sort of purple there. Again, the bankers' dividend is historically growing sort of between 2 and 3 times inflation every year. And I think that's the power of equities as a whole, but also the power of sort of trying to find the best opportunities for dividend growth over time. So great record, and say that record of growing the dividend since 1966 as well is important. Capital on the next page. I won't labour here too much. Always go to the website. The data there is much more current. Our last financial years here, we just fraction behind the FTSE World Index to the end of October, our financial year, and we're about 1% ahead of it currently. So again, we're catching up with what is quite a growthy market. Given our sort of income and growth biases, I think they're quite pleasing to me. So let's look at the portfolio. That's sort of introduction in terms of the next page. Again, we'll whistle stop tour here and we'll get some questions in a minute. But here's our portfolio positioned by sort of sectors and regions. Really, we've been, we took quite a big position in information technology tech about 3 or 4 years ago. It's been very good, and then we cut it back in 2022 when we thought both prices were expensive and the market was sort of broadening out into more value as interest rates were starting, long-term interest rates starting to rise. We've actually gone back into some tech names, obviously with the AI sort of boom, and particularly in the semiconductor space, I'll show you later. So we're just a fraction underweight the benchmarking there. Financials is a big position for us, particularly banks. We think with interest rates staying higher for longer, that we should see banks actually prosper in that market. And we don't see a bad debt environment, particularly to take away some of the profits there. Elsewhere, some industrials is another area we've been beginning to build up as we hopefully get some interest rate cuts. We're sort of towards the bottom of the cycle in terms of industrials being a bit weak. Regions-wise, unsurprising to see North America, the bigger one there. Maybe surprised to see, Japan is quite a big exposure to us at 13%, and then the UK also, where again we can maybe get into questions there, but we see good value in that market. In terms of our outlook, what are we seeing in terms of markets on the next page, Roland? I very much, as a backdrop, fundamental driver for me for returns in equities is the cost of capital. It's what companies are essentially borrowing money at over time. And there's been, as you can see here, a very fundamental sort of reset of long-term interest rates. This is government bonds, and obviously what companies borrow at is a margin over government bonds. That margin can contract and expand depending on whether money is freely available or tight, but essentially you can't get away from the government bond yield here. And in my career, I remember 9–10% government bond yield, fell all the way to negative numbers for some European countries in Japan, and we've seen a fundamental reset towards a sort of 4% level. And I think the consequences of this have still not played out in equity markets, equity pricing. I think probably private equity as a much more challenging environment down the road than the public markets. But equally in there, we'll see some consequences of this over time. I don't see this going back. I think inflation is likely to prove a bit more permanent in these sort of higher levels. Again, if we jump on a page, Roland, sort of summarizing some of my thoughts, I sort of see inflation more volatile. We're seeing shortages of labor which aren't going away. A lot of issues around climate change are inherently inflationary. It's going to cost a lot of money. There we said governments perpetually sort of wanting to spend money, interfere in the economy in that sense, and deficits widening. These are all, to my mind, inflationary aspects. So I see 2% as more a floor. We might sink under it in the short term, but we will find, I think, inflation bubbling away. The positives, though, are actually that means sort of slightly higher nominal GDP, higher real GDP, and technology is still driving some great benefits, productivity for corporate profits. So again, corporate profits should be tends to be pretty good, I think, in the future. I'm not a huge advocate of AI. We can get maybe some questions in there. I think there's a limit to what the current generation of AI will deliver, but it certainly will deliver productivity in a number of industries. I mentioned before, I do sense a rotation from all-out growth towards a bit more of a balance. So some value sectors, for instance, as I said, banks, we see as a good value area with good growth opportunities. And then there's a lot of fascinating themes out there, sort of deglobalization, supply chain reshoring, as it were, as governments want to bring more supply chains internally rather than externally, as it were. Climate mitigation, all the climate change investments that's required is fascinating investment theme. Defense and then commodities to supply a lot of these new investment spending. So these are all fascinating areas, I think, opportunities for investment outside the typical sort of interest rate driven, sort of economically sensitive sectors. So I picked three to sort of maybe highlight. If we jump on, we start with semiconductors, which is probably our biggest exposure, just over 11% of the portfolio in a number of stocks I've listed on the right-hand side there. And really, I think we need to remember again, semiconductors is inherently a cyclical sector. It does have a sort of boom-bust cycle over time, and that's because it does take a long time to produce a semiconductor. It's sort of 100 to 150 days for the more complex semiconductors. So the industry is always second-guessing demand. And then there's big jumps in technology. They're called sort of nodes here. I've listed some of them on the left. This is the cost of a sort of 50,000 wafer factory per month. So a reasonably big factory, in billions here. And you can see as we've jumped towards the right in terms of ever smaller chips, oddly, the sort of node doesn't actually mean anything in a physical sense, but it's what we term these jumps in generation. If I sort of 5 nanometers is almost cutting edge now. It's what the Apple sort of M2 sort of range and the Apple sort of 12, sort of 14 was. We've just moved to 3 nanometers at cutting edge, which is the Apple 15 is in there, and Apple is going to probably use 2 nanometers in 2025 towards the end of 2025, 26. So we're just developing that technology currently, but you can see big jumps in capital expenditure required. So again, the industry second-guessing demand. But I think here we're also seeing very good demand from reshoring. So Europe, America, Japan, China as well, wanting to bring most chips, 90% of all the AI chips are made in Taiwan. And again, I think a lot of countries want more of this manufacturing locally. So we're seeing a big investment spend coming through. So a lot of the companies we own, make parts of the processing of a chip or the chemicals that go into manufacturing chips, or just the quality control. So lots of interesting names there that we really like in this space. And I think this cycle has a bit more to run, probably peaking in 25, 26, and then we will want to be a bit more cautious about maybe volumes exceeding demand. But in the short term, this is a great sector that we see a lot of promise. On the next page, electrification is another theme we think very interesting. Again, feeding into some of the spending required to get to net zero. I'm not convinced we'll get there, sadly, by 2050, but I think a lot of spending will occur. And the graph here is showing you, the US market for power demand, it's been very flat in the last sort of 10, 20 years. And that's because growth has sort of counteracted efficiency gains with LED lighting, ever more efficient processes in manufacturing. The demand for electricity has been pretty static. But over the next 20 years, we see that rising very dramatically. As obviously, cars pretty much electrify completely. We see sort of data demand, data centers growing rapidly. And so, economies need electrifying. This needs a lot of spending. So again, a lot of interesting companies, some on the right there, Hitachi, Siemens, that we see really benefiting from capital expenditure. A lot of the networks, the power grids are 30, 40 years old in cases, very old, particularly in Japan and America. We'll need a lot of investment spending. So again, this is an area, only about 4%, but we're growing this reasonably rapidly. And then finally, Japan is an area I'm really very positive on still. Pretty cheap still and very unloved. I think Europeans have been buying rapidly into Japan. I think the Americans still haven't quite rediscovered it. But I think we're waking up actually to the realization that an aging population is not actually deflationary, it's actually inflationary. So once people retire, they tend to spend. And we're seeing actually the deflationary trend is actually when you're saving for retirement in your 40s and 50s and early 60s. So actually we're seeing inflation trends improve in Japan. That's helping the stock market, it's helping get off that zero interest rate policy. We're also, the key for me is corporate governance though. We're seeing historically misallocation of capital in Japan. A lot of companies hoard it, cross holdings, jobs for life. That's all changing. The stock exchange really pushing for a lot more activity of companies to improve balance sheets, and then the government pushing for more M&A, mergers, acquisitions, and really activism to take hold. And we see here this graph just showing, that while earnings are growing at 7% over a sort of 10-year period, we're seeing 9% growth in dividends. So that's shareholder activism coming in, and then 17% growth in the value of buybacks. So again, this is the cross holdings being unwound and companies returning surplus cash to us as investors. So I think this is really leading to continual gains in that stock market. So with that, just quick summary on the next page, and then we'll go to some questions. So let's say global exposure to equities, and that sort of growth and income style, best ideas is really what we're looking for, and global reach across 4 regions. So with that, Roland, I'm happy to take any questions.
So first up, question about interest rates. If interest rates do start to come down, what impact do you think that would have on the portfolio or change your approach to investing?
Well, I think the key one's the US interest rates. I think the market has a usual sort of short-term rally as it thinks, great, we're off. History tells you rates get cut quite rapidly, actually. They rarely, that's usually because the governments, the central banks rather, have lost a bit of control of the economy and you're heading up in a recession. I don't see that this time, so I see more steady, maybe once a quarter, 2 or 3 to get us going, but once a quarter, sort of coming down towards the 3% level over maybe 12 months, 18 months. And that's pretty positive, I think, for markets. The first couple of cuts, if we're honest, don't touch the sides. You need to get rates, I think, down towards that 3% level, which should allow companies that are borrowing, short term, to see the benefits coming through quite quickly. In the US market, most mortgages are on the long-term rates, so it won't come through that quickly to a lot of saving. But there's always people rolling these mortgages and refinancing. So again, I think it'll have a reasonably positive impact, definitely on equities, but I'm hoping it is the breadth we see. It's not the narrowness of a few winners taking all that we've currently got in the market, because more sectors will do well as rates get cut.
Couple of questions on Japan. First, saying I like Japan. What are your thoughts on the yen? Could bounce strongly if Bank of Japan takes action. How will that affect your approach to Japan? And secondly, to that next question, how are you dealing with yen depreciation? So, yeah,
I think you've got to, I think currencies drive on a few things. The first one is pretty mathematical, which is the interest rate differential. So you've got sort of 5% differential between sort of US rates, our rates, and Japan. So you'd expect on current rate, 3 or 4, 5% devaluation to come annually. So expect it to continue in that sense. And then it's all about flow, really, of flow of capital. coming through, and confidence. And I think, starting to get some rate rises gives us confidence that the economy is growing, that inflation is slowly coming back. I do believe that's coming through. We're seeing it in wage growth. That will come through investment in consumer spending. So I'm expecting at least a rate cut coming shortly. The US will be coming the other way, so the differential narrows. So I think, marginally a little bit more weakness from here. There's a lot of borrowing in yen to invest in. It's called the carry trade, and you borrow in yen virtually nothing and buy some more interesting racy assets. There's a big pent up amount of that capital that if the currency could just find some confidence and some strength, you'd see a lot of that could snap very, very quickly. So, I think it has the potential to appreciate in the next sort of 12 to 18 months. The short term, probably not, but I think a lot of the pain's been taken at whatever, 161, 162 or something to the dollar.
Next question is on the same theme. How much currency hedging do you do? What's your strategy around currency hedging?
Yeah, so I think you hedge currencies and bonds because the cash flow is all in the same currency, whereas in equities, it's a nightmare because you just don't know what the companies are doing, where they're positioned. So if you pick a global name as sort of Microsoft or something, you have no idea whether it's how much of its business is coming. You have a rough idea, but in different regions. So it's just saying, right, it's all dollars is mad. You wouldn't hedge a Swiss pharmaceutical against the currency, and we saw it in the UK when Brexit occurred and the currency fell, the stock market rose. So I just think you take it on the chin, and it's best done that way. And you try and, focus it a little bit more in your mind and buying the best companies and trust them to hedge the currencies by putting manufacturing in different regions or seeing the cash flows come through, and the good companies do that for you.
Okay, next question is about financials. Which sectors of financials do you like, and do you own any UK banks?
Yeah, we do. Lloyd's is our biggest sort of, it's just outside the top 10. I think what I like about the sort of more sort of retail banks really is that as rates went up very sharply, a lot of them hedged their deposit base, and so you will see quite a slow recovery in what's called net interest margin, which is their surplus deposits earning interest rates. And so I think there's another year or two really of seeing Lloyd's net interest margins rising as long as interest rates sort of stay broadly 4 to 5%. So I think there's more to come on that than people appreciate. I think people are more overly worried, I think, by both, larger taxes or bad debts, taking the shine away. And I think, again, banks are required to be healthy for economies to grow, and they lend to people wanting to expand businesses and grow and take on mortgages. They're incredibly important to the health of an economy. So I think, again, governments won't want to see that taken away. They want to see banks lending responsibly and healthily. So I think it's a sector that it's still, again, I go back to when I remember them at sort of 1.5, 2 times price to book, and you can still buy them at below book value. And, in something like Japan, they've been our best contributor. Sumitomo, been a fantastic return the last 12 months. And just as those interest rates, again, starting to rise. So I think that's our favorite place. I think insurance would come next. Property casualty is more problematic. Because you can have some big events that make life a bit tougher, and I think with interest rates quite high at the moment, that's also proving difficult in the property casualty side. So I would rank it in that order.
Okay, probably got one or two, maybe one more to go. Question about management. Do you get to go and visit management, or do your teams out on the ground go and visit management? And how much importance do you place in management?
I think having trust in it is important to meet management. Just having, quizzing them, do they know the numbers? Does a finance director have the numbers on the top of his head? And the confidence you can see, and quizzing them on, there's nothing inside and all this, but I think it's having the confidence to meet people and question them, how they run their businesses, and over time see how that changes. So we do meet management. We're lucky enough they all travel. And we can meet them in a lot of the places we work, but we do go and visit them either at conferences and often kick the tires in the factories as well. I think it's interesting to connect with businesses and see how they operate. So I think it's part of the process. I think equally important there is a deep understanding of the industry, of the drivers, of how the competition is, where they are in the competition, whether their products are, have an edge and pricing and how they can, and that comes out of experience, I think, of just, being in different environments, different markets over time.
And one final quickie, which just come in, but I think actually is really important. And the question is saying, I may have missed it, but what's your gearing and cost of debt? I think you had it earlier on, but on the slide. But
the gearing is down to about 5%. So we could be at about 8 or 9 if we wanted to. So we've, markets have had a very strong run in the last 3 or 4 months, and so we've just taken a few profits here with the point of just pausing to see, whether we can rotate that into some new names, really. So it's not a negative. It's just naturally taking some profits. And then we've got debt now. We don't borrow anything in the short term. We're not using expensive short-term debt. It's all pushed out almost into the 2030s, and the last one is 2045. So at 2.8%, which is ironically exactly the same as the yield on the portfolio. So the income we're getting in dividends is paying that debt. And so over the next 20 years plus, all the return, all the capital and any growth and income is going to come to investors in bankers. So I think it's a really nice place. There was a 12% debenture when I first started, but you imagine borrowing at 12% and trying to make money. It's a very different place. Very different place.